Hello, everybody. My name is Marc de Kinderen. Welcome to this session at the Super Investor. Unfortunately, it's a virtual event. Amsterdam is my first and second city. I live in New York, but I am Dutch, as my accent probably tells you or gives it away. So I very much enjoy coming to conferences in Amsterdam, since it's basically my hometown. Well, this time around, I'm still in Amsterdam, but we're doing this virtually. So thank you for joining us. And we're going to be talking about spin-out teams. We're going to be talking about emerging managers. It's about starting your own fund, starting your own firm in this very difficult period of time. Starting your own firm and starting your own first buyout fund, private equity fund, is difficult even in great times, right? I've done it actually 20 years ago. Took me 10 years to get to the level where we were a bit profitable, to be honest with you. Timing and reserving capital to start your own firm is recommendable, to say the least. We, as a fund of funds, invest in emerging managers, spin-out teams. It's not that we do this as a core, if you will, strategy that we only want to invest in emerging managers, but we only invest in what we call the lower end of middle market. Small cap buyout funds in the United States and in Canada. And if you invest in small cap buyout funds that are 100 million, 200 million, often they are first time funds. The time that you get to fund 3, fund 4, most of the times they have grown to what we consider to be the mid-market. So as a firm, again, based in New York, we invest in these smaller funds. We make about 5 or 6 commitments every year, and about 3 of them are in first-time funds, true spin-out teams, emerging managers. So as a moderator in this team, I'm very much looking forward to getting input and guidance from other LPs, as well as from a GP who did it himself. Our case study, as we just discussed earlier in our preparation. So perhaps I'll start with maybe Tom. Do you mind introducing yourself and giving a bit of background on the kind of emerging managers that you select and how you invest in them?
Sure. Thanks very much, Marc, and great to be here. Well, again, better to be in Amsterdam, but London is okay for the time being. Yeah, so I'm the head of Europe at Wafra. Wafra opened up an office in Europe 2 years ago when I joined, and Wafra, yeah, for a number of years we've seen the opportunity, like a lot of people do, in first-time funds and emerging managers. There's data around. I think Prequin and Tim Jenkinson has just come out with a new study suggesting that first-time funds and emerging managers can outperform. It's a thesis that we believe in, and we're not unique in that. I think a recent BVCA emerging managers barometer survey showed that about 96% of LPs see a value in emerging managers. I guess the difference is we've decided to treat it programmatically and to make sure we've got the resources and time available to actually execute on the opportunity set, like others on the call.
Thanks, Tom. David, maybe you want to explain the role of your organization, if you will, in the emerging manager space and whether or not you look at spin-out teams?
Yeah, absolutely. Thanks so much, Marc. So I'm David Enriquez. I'm head of private equity at New York City Retirement Systems. And to put emerging managers in a bit of a context, we manage a $24 billion private equity portfolio, and we pace at around $3 to $3.5 billion a year in private equity commitments. We have a strong focus on emerging managers. We've been investing, my 6-person team has been investing directly as an LP in emerging managers since 2012. And you should think of us as having 2 pools of dedicated capital. One is a direct program where New York City is the investor. And then just this summer, we closed on a $600 million separate account with Neuberger Berman, where we're focused on early stage first-time funds, because we recognized as a large pension system, we weren't as involved in, it's hard to use size as a proxy, but call it smaller or earlier stage of development for spin-out teams and emerging managers. So in total, there's about $1 billion plus of dedicated capital in our program for emerging managers. And let's just say, to be invested over a, 3 or 4 year investment period.
Okay, great. Thank you.
Yes.
Maybe I'll jump to María, and you can give us some guidance on your organization and how you look at new teams coming to market. Obviously, we're talking later on about the COVID times, but right now, just the philosophy of your firm.
Thank you, Marc. My name is María Sanz. I co-head private equity at YIELCO, YIELCO is an alternative investment boutique based in Munich. We invest in infrastructure, private debt, and private equity. Within private equity, we have a very special focus on what we call special situations. And this is for us from distressed for control, turnarounds, complex buyouts, carve-outs, this kind of value investing strategy. We invest in the US and in Europe. The focus is small cap, mid-market, and there is a lot of new managers emerging in this kind of strategy. There are a lot of spin-outs from larger groups that go back to the origins of investing in the smaller transactions and not just the big ones. And in this context, I think in our portfolios, probably 1/3 of the investments are spin-outs of other organizations or first-time teams getting together.
Great. Well, so it's pretty clear, I think, to everybody who's watching or participating, listening to this panel, that we have enough LPs who are experienced in dealing with spin-out teams and also the challenges, of course, of funding those. But we also have a real case. Cristobal, you are a spin-out, if you will, emerging manager. Perhaps you can give our audience a bit of a description of your firm, but maybe more importantly, of your fundraising experience and organizing your first fund.
Sure. So I'm Cristobal Cuart. I co-founded LPs Capital together with my partner, Marc. The two of us had worked together for over a decade at KKR. And in 2008, we decided to spin out and start LPs. We started at the very beginning of 2019. The first year was really building the infrastructure of the platform, hiring people, starting to have initial conversations with LPs, and framing how we wanted to go to market and how we wanted to get deals done. And it was during COVID when we had our first close with our initial cornerstone, which is Constellation Capital. We raised just over 130 million euros, got our first transaction done in the summer, and we're now off to the races. I think the fundraising has certainly changed pre-COVID and post-COVID. Obvious things to mention is the focus on Zoom meetings and both the pros and the cons of those Zoom meetings. But I think the fundamentals remain there, having a very solid, strong team, very identifiable market opportunity, a strong track record. And then it's how do you build trust and relationships with the LPs and the different contact ways that you have, given the COVID difficulties. Yes,
well, that's actually, thank you for that, and also thank you for setting it up for our next discussion point. So, there is a difference, pre-COVID and call it in COVID, and then hopefully in the near future we'll call it, post-COVID, right? Let's work on that. Well, other people are working on that, I guess. So maybe Tom, if I may ask you first, compared to supporting spin-out teams, in the last decade, if you will, versus what it's been since March, do you see any trends? Are there certain funds, certain approaches perhaps that are more, attractive today than they were maybe a year ago? Are there other things? Are people raising smaller funds? What are the trends that we see in COVID in fundraising for these more emerging managers? Okay, so I guess the first thing that I suggest is that new relationships for anyone during COVID are hard, right? So it's the reality is if you're a first-time fund or a spin-out fund,
you've got to build a lot of new relationships from your new seat. And so, but it's no different than if you're a fund 4 and you've never met someone. And in COVID, it's still difficult, right? So new relationships, I think, is the key. I don't think COVID itself doesn't change and I don't think most of the LPs that we talk to doesn't change their thesis around the value proposition of first-time funds and spinouts. And perhaps the contrary, in that the idea that COVID is accelerating some trends that we've seen anyway. And when things accelerate, you tend to see them a little bit better. Emerging managers and first-time funds, one of the ones that are successful have a very clear value proposition. They're offering the market something that you can't get as easily or can't get as well out of a fund 8. Any LP that can do a fund 8 instead of a fund 1 is going to do a fund 8. We're lazy and risk-averse people, right? And frankly, it's the return on time of that is very clear. So so there has to be a clear value proposition, and we're seeing that, right? So if you think about, we've sort of around COVID, during the COVID times, we've closed 2 and almost a third relationship with an emerging manager, first-time fund, and it's people who are and the people that we've done anyway, communications, decarbonization, financial services, life sciences and healthcare, preferred equity, structured equity, which we think there's a huge opportunity in Europe for that, like we've seen in the US, financial services, right? So those are the kinds of themes that we have ended up going into with first-time funds, because those are the strategies that we think are relevant for the future.
And María, you obviously, as a firm, you focus on distressed turnaround special situations anyways. Do you see, I've had quite a few of LPs calling me and saying, well, I assume you're going to do a lot more turnaround funds, right? As a fund of funds. Right,
it's the flavor of the month currently, yeah, that's true.
Isn't it? I believe so. Do you see that there's, also more spin-out teams coming in that space than they see maybe an opportunity, a special opportunity perhaps, to raise a fund in this market because there's a trend, there's so much interest in it?
Well, it depends from regionally, right? I think in the US, this is a constant deal flow of spin-outs and new teams getting together. So we haven't noticed that there is more activity on the spin-out area during COVID. And the idea of setting up your own firm is not something that, appears within a couple of months. So you have to resign, you have to leave, you have to set up a team. COVID hasn't been ongoing for such a long period. So I think the teams that are now in the market, most of them had already that in mind and were looking to spin out before. In Europe, we have seen more deal flow currently on the emerging manager side. And I think this also relates to COVID, together with this strategy that investors might be more open to back teams looking for distressed investments and turnarounds, because we expect to have a lot of deal flow in the coming months, years.
Sure, that's clear. I saw, by the way, Cristobal, going yes, just starting your own firm and resigning, and I could see the months just flowing by in his view, in his face. It's like, yes, and then a year later, and then another year, it takes a while to prepare. But it's exciting, when you do so. I believe that, I would encourage anybody to think about it if you're an employee at a larger private equity firm, because it is exciting to be an entrepreneur. And it's exciting to start from, having no legacy portfolio and being able to build your own portfolio. So I, with all the challenges that there may be, I would definitely suggest that people think about it if you're entrepreneurially minded. Do you see, maybe from more of a helicopter view, certain trends in private equity occurring in terms of fundraising with these younger funds? Is there certain types of funds that are coming out? Do you see more funds coming to market, less funds to market? Anything that might help our audience?
Thanks. I think like from my perspective here in New York, and I definitely, I think, have a little bit more of a bias to the deal flow in the United States, but I've spent a meaningful amount of time in Europe, more for our core portfolio, which is kind of upper mid-market, large cap. I think that there's a big difference, right? At the helicopter view, and maybe piggybacking on something María said about the difference in deal flow in the US versus Europe, I think one of the challenges that spin out teams or emerging managers face in Europe compared to their US counterparts is that in the US market, it feels like the emerging manager ecosystem is more mature or more developed, right? I could think of 6 public pension plans, including New York City, who have dedicated pools of capital just for emerging managers. And they can define it by assets under management or what you have on the cover. When we ran our process and we selected Neuberger Berman as our partner for this separate account, we interviewed in a sort of bake-off process 15 firms, right? So 15 private sector, fund-to-fund, multi-strategy firms who do primaries, co-invest, and secondaries. Whereas when I look to Europe, I think the challenge is there are fewer dedicated pools of capital. But what I see, if I'm at the helicopter view and I actually go higher to say 50,000 feet, what I would say is what we have in our industry is, a universal dynamic where you have this 10-year limited partnership structure, a carry-based compensation system, and what I would describe as not just normal human nature, but kind of alpha GP human nature. And that's who we want to align with as LPs. We want to align with business people who want to generate returns, create wealth for themselves and their investors. And I sort of say you put it in a cocktail shaker and shake it up, and that's the private equity industry. What that guarantees you is perpetual deal flow of emerging managers, because we will be unable, right, as just based on our human nature to success, GPs will not always successfully transition economics, decision-making, management, right? And I think the opportunity that Tom mentioned and the thesis around outperformance, I think it's partly driven through positive self-selection, right? You don't get the B players or the bench players who say, I'm pretty mediocre, let me spin out and form a fund and I'll raise, 300 million euros. No, it's as you mentioned, Marc, it's an entrepreneurial investor who's willing to take risk, right? Who wants to, manage his or her own destiny. But the key is finding the capital, right? And I think maybe that's one thing, from the LP perspective, Tom, María, and I can provide, maybe some insights into how do you navigate that system? Because there are definitely LPs who recognize the opportunity set.
Yes. So maybe we just jump in that right now, in terms of advising our audience, most of whom are probably thinking about, spinning out, starting their own firm. What are the steps? But I definitely want to, go to Cristobal at the end of this little round, because he's the one who's actually done it, right? But David, please continue. Name us 1 or 2 guidance in terms of how can you, if you're spinning out and you're creating your own firm, how can you now in this difficult time get access? How do people get you on the phone or perhaps get your advisor on the phone? What's the best way to do it?
Yeah, I would say, I think in this remote work environment where we're doing video conferences, and virtual meetings, I would say almost like flip the script, right? We're often complaining about how it's not as intimate, you don't get to shake hands, you can't read body language. I actually have developed a completely contrarian point of view. I think that when you have an existing relationship, on a scale of 1 to 10, I can have a 9 quality meeting with someone I know, right? With a first relationship, when I'm just meeting somebody, maybe at best I can achieve an 8, right? And I think what I would encourage people to do is, one, like if you're a team, an emerging manager, or you're thinking about spinning out, or you want to talk to LPs, there are a few practical things I would say. One is, try to, get a warm introduction, right? Use your network, right? To see if there's a relationship, because that always helps to pave the way. And there's more openness when you're being introduced by a common friend or, somebody in the industry. And I think the second thing is, and it can be a challenge because like business cultures differ, but I think you have to take some risk, right? I remember, I used to be an investment banker before I became an LP, and I've only been an LP for 4 years, so I'm probably the rookie on the panel. But from my banking days, I remember, we were taken up to the executive dining room when we got promoted to being vice presidents. And the senior managing director asked all of us, what is the point of your first meeting with a client? And then, a bunch of people raise their hands and they'd say, we want to win the mandate. We want to, capture more of the wallet. We want to get, closer to get from the head of business development to the CEO. And the managing director said, you're all wrong. The point of your first meeting is to have a second meeting, right? So you need to think that way, especially in this remote environment, is like, engage, and then you need to share, right? There needs, like, your counterpart needs to walk away from the meeting having learned something new, gained an insight, or as a GP or an emerging manager, like you piqued their curiosity or you tee up some follow-up, right? Sure. And I think that's one of the things. And I think all of that you can accomplish over a Zoom or a Teams call. But let me pause there. I'm sure other folks have great advice to give.
Tom, maybe I'll jump to you. Thank you, David. So I'll jump to you and I'll roll in actually a question that we got from the audience. I'll try to be cute here. We'll make this interactive as possible on the Zoom concept. But so a question from the audience is when you do due diligence on a new fund spinning out and you're looking at the track record, it's hard to do a pure financial track record. Most of the times, perhaps they don't have, attribution or other ways of really, proving their track record. How important is track record for a spin out team? Number one. Number two, are there other ways to look at track record than pure financial? Having operational experience in your resume, if you will, does that help as well when you're looking at spin out teams? And then maybe we can connect that with giving them advice, to people thinking spin out, in today's world.
Yeah. Okay. Well woven in. Marc.
I'm trying.
So the short answer is yes. We have backed. So what we're looking for is teams, right? So rarely individuals, right? But teams who have got the right to have a vision. Lots of people have visions. Not everybody has got the experience to have the right to have that vision and have it backed. And so that vision has to be something, and that sort of, we need to be able to assess the credibility of the person who's got that vision. And somewhere in the team, there needs to be investment experience. We have backed people with operating experience, people who have sort of started companies and sold companies and decided, I want to move from being the entrepreneur to being the investor, the GP. And sometimes in terms of vision, those people are fantastic, but there still needs to be some, private equity expertise on the team somewhere. But that doesn't necessarily have to be the lead on the track record. So the short answer to that is yes, we have done that. The other thing I'd say just very quickly is one of the reasons why we think the smaller end of the market is interesting because it can be less competed. And if your thesis is we want to operate, the alpha that we're going to bring is relatively more through origination than it is through operational improvement and a clever exit. You don't need as big a team to do that, but you need deeper networks, right? And sometimes those networks are going to be coming from people with more of an operating background, perhaps, than just a pure financial investment background.
At the same time, I believe that if your key advantage is sourcing, having a brand name as a private equity firm, as a GP, may also be important, so that everybody knows who you are and brings you transactions, investment bankers and other groups, brokers, etc. So.
Yeah, just to come back on that quickly, I'd agree with that. The other thing that I think is changing the dynamic, and momentum is the key for everyone, right? So the question is, where do you get momentum? You can get it from your team's growth. You can get it from deals. You can get it from the fundraising success. for us in this environment, the deals is the key thing. And there's a lot of flexible capital out there.
Sure.
And LPs who either themselves have in-house expertise on directs or have got advisory relationships with people who can help with directs. So I would say perhaps you can get some of that brand through some of the investors that you're working with as well.
Yep. Yeah, fair enough. And by the way, for the audience, if you do have a question, you can just, chat it to us and we get them served here on our computer somehow. And then we can try and weave them in to the conversation, if you will, rather than waiting all the way at the end and then maybe running out of time. So if you have a question, please don't hesitate to send it to us and the organization passes it on to us and we'll try to put it in here. Cristobal, for you here for a second. So, you've done this and you've gone out and you've raised that first fund and you've had a first close in the whole COVID timeframe, etc. Your recommendation to the people who are watching here and thinking about this and also including that track record, what's your experience speaking to LPs like all of us, the other four here, if you will? We look to reconstruct track records. Even if you don't have attribution, we can make this thing happen. We can see operational value. We can see, value being created, even if you've not had an exit. But let's be honest, okay? The realized track record as a spin-out team, how important was that to you at that time and maybe even today?
Sure. And when thinking about fundraising and setting up a fund, there's so many, the most important things that matter. But from our perspective, as we started this journey, it was having a very clear path and a clear journey on where we wanted to get. But very quickly, you realize that one of the most important moments, the 0 to 1 in the life of a fund, is getting that first capital. So all of our efforts concentrated on how do we find a cornerstone or a group of cornerstones that effectively will help us get to that first close. And then working back from that. For us, that meant having a very clear track record, and coming from a large private equity firm like KKR, that meant that they would not give an audited track record. But how do you recreate that effectively? How do you go deal by deal and get third-party references on that track record, whether it's KKR partners or ex-KKR partners, whether it's the accountants, the CEOs, the advisors in a deal, people that can vouch that you sourced it, that you did the transaction, that you were effectively leading that transaction at the firm. So that's something that matters and it's really important. Once you've crossed that, is build an infrastructure that gives comfort to LPs. It's not about you. It's not only about you and your partner. It's about the whole team that you're putting together. And that goes both on the deal side, but also on the infrastructure. Have very high quality GCs, COOs, CFOs that can give confidence to the investors that the risk they're taking is with the deal teams, not with the back office or with the infrastructure, and build an organization that's willing to last. And then it's around how do you connect and build those relationships with the investors. I think the number one point is have conviction around what you're doing and around the market opportunity that you're seeing, and you want them to invest with you. If you don't have that conviction, nobody's going to effectively trust you or want to give you capital. And one of the ways to show that is through deal flows, but the other one is also putting your own capital in the fund and being a very, very, very material portion of your wealth that goes into the building the business, but also into the fund, and seeing that the rest of the team is also following on that. It's not only the founders or the key people in the fund, but also the more juniors, and the conviction that comes from that, I think, is a very, very important thing. And then if you have relationships with LPs, that's a great place to start. But if not, you need to recreate them. And as David mentioned, nothing helps as an introduction from another LP or somebody in your network. Don't be afraid to ask. Ask for those recommendations or suggestions. And I think that people want to see entrepreneurs succeed, and the level of help, of ideas, of mentoring that we receive from people of all parts of the market has been phenomenal. So don't be afraid to ask from that perspective. And then the final one is time. kind of things during COVID take more time. Don't expect that you'll kind of start a kind of January 1st of 2021 and you'll have your first close in June or July. Give yourself the time to prove the concept, to build the team. And if ultimately you have conviction on what you're doing, that might be a year, 2 years, or 3 years, but be willing to do it for the very, very long term. And no matter what kind of the market or the environment throws at you, have that perseverance to make it through and drive through. And that's ultimately the biggest aspect that will guarantee success.
Motivational. Thank you. Yes, go for it. And the one thing in our preparation talk that we had, it's getting to that first close, and it's getting to that momentum and the moment that you become real for a lot of LPs. A lot of LPs don't look at funds until they've had a first close, because at the first close they know that the fund is actually for real. So why will we spend time and effort and legal expense, et cetera, if you're not really sure whether or not the fund is actually getting off the ground? María, maybe a question to you. Recommendations of getting to that first close. What is it that gets people like you and me and other people, Tom and David, excited about joining a fund and being part of that first close? How do you get that momentum?
Well, I think first we have to see this motivation on the team, as Cristobal was saying, that they want to set up something together and they have this energy. But also coming back to the other question that there was, we need some track record. We need a track record in some form. So we are very agile in, even if the track record, of course, is not attributed to have a lot of references, to talk to former managers, to other LPs, to the whole network, to understand what was the role of the people in this investment. And also for our kind of investments where it is value investing, there are hairy deals, there are turnarounds, there are things that need to be fixed, and they need to be fixed fast. There we also need some operating experience. So ideally it is somebody with some operating background and also the private equity side, probably in the form of a different partner. And also very important, it cannot be a two-man show. So it's not like two buddies getting together and say, we're setting a private equity fund. As Cristobal was mentioning, there has to be the whole environment around them. I mean, we need to be sure that when we have a first close, that they know how a capital call works, that they know how financial statements are being done. Those are important things, and we need to make sure that it is not a black box. And we need to be sure to make sure that they can work with two deals at the same time, so they have enough resources, like one partner working on one and another one until a deal gets done. All these things are important. So we were talking before, we just had a case in LA where Marc and I are both invested, and it's a first-time fund, just managed to have the final close. And I think my first meeting with them after spin-out was in December 2018. So it took 2 years, and it was already a team which was large. We had a common background, had a very good track record, and it was attributable, and a lot of tick the box exercises we could do on our end. But at the end, it takes time. It takes time, and the team has to be able to survive for quite a time without having management fees coming in.
Yes, I hear you, and I second 100%. And so, as we only have I think 1 minute, maybe 2 minutes left. 1 minute. We're supposed to wrap up. So first of all, before we get cut off, because I don't know technology-wise whether we're just going to get cut off here. So I want to thank everybody on the panel, for participating and giving your guidance to all of us. And in the end, maybe from my perspective, having that infrastructure, yes, having the time, maybe 2 years, maybe 3 years, and have the capital to be able to do that. And then focus on that first close, get a cornerstone investor, maybe do 1, 2, 3 deals as an independent sponsor, and build a track record that way if you don't have an operational or a financial track record before. I think all of us here on this panel are excited about emerging managers. We look at emerging managers, we evaluate emerging managers even during COVID times. So we wish all of you who are considering this good luck in getting ready if you're planning to spin out, and reach out to us. If you go to Cristobal, if you want real, operational experience, come to the others if you're looking for capital. Thank you very much for joining us.